This is Professor Russell James coming to you from Texas Tech University. Welcome to today's lecture from Visual Plan Giving, an introduction to the law and taxation of charitable gift planning. Welcome to Income Limits on Charitable Deductions, Part 3, Gifts to Private Foundations. This is Professor Russell James. As mentioned previously, 50% is the default income limitation for deductions from non-cash charitable gifts to public charities. An exception to that rule is made for gifts of long-term capital gain, which in some cases trigger a 30% income limitation. There are, however, some deductible gifts which are not considered to be made to a public charity, but still benefit a charity. These relatively rare transactions fall into the category of gifts made, quote, for the use of charity. Gifts, even gifts of cash, made not to a charity, but for the use of a charity, do not qualify for the 50% income limitation, but instead qualify for a 30% income limitation. Such gifts of long-term capital gain are restricted to only a 20% income limitation. Although the general principle is that this term encompasses any money given in trust to another entity where the charity receives current benefits, there are really only two common scenarios where this issue arises. The first is paying premiums directly to a life insurance company for charity-owned life insurance policies. The charity benefits from the transaction because its life insurance policy premiums are paid. However, the money actually goes to the life insurance company, which is not a charitable entity. Similarly, a deductible gift can be made to a grantor charitable lead trust, where the trust pays a fixed amount of the gift to a charity each year for a period of years, with the remainder going to some non-charitable beneficiary. Again, the transfer to the charitable lead trust benefits the charity, but the charity does not receive its share directly, only indirectly over time through the trust. Note that this issue does not relate to charitable remainder trusts because charitable remainder trusts are themselves charitable entities, whereas charitable lead trusts are not. Given that these are normally the only two applications of this special rule, it may be easier to simply note these two scenarios as exceptions rather than thinking of the general principle involved. As discussed a bit later, the carryover deductions in excess of these limitations, quote, for the use of charities is currently uncertain. Public charities are favored recipients in the income limitation rules. Consequently, gifts to such charities can generate deductions with income limitations of 50% or even 60%. In contrast, gifts to private foundations never generate greater than a 30% income limitation. Private foundations are somewhat less favored by the tax law. Typically, private foundations are family foundations that are controlled by the donor and the donor's friends and family. Although such private foundations do make annual distributions to public charities, they do not directly operate or manage charitable work. Being one step removed from charitable work and typically being controlled by the donor and the donor's family, these entities are given tax benefits, but not to the same degree as public charities. The rules for income limitations for gifts to private foundations are somewhat similar to those for gifts to public charities. Any gifts, except for long-term capital gain, qualify for the highest income limitation for private foundations, which is 30%. Conceptually, this is a favored asset, in other words, not long-term capital gain, being given to a disfavored organization, that is, a private foundation. Thus, the donor receives neither the highest income limitation of 60%, reserved for the most favored gift, cash, going to favored organizations, nor the lowest income limitation of 20%, reserved for disfavored assets, going to disfavored organizations. Although the slides use the example of the Bill and Melinda Gates Foundation as a private non-operating foundation, donors rarely give to other people's private foundations, but instead create their own private family foundations, which, along with their friends or family members, they typically control and manage. Indeed, often one of the defining characteristics of a private foundation is that it does not receive substantial charitable gifts from the general public. Instead, private foundations are typically supported predominantly by gifts from one family. The same types of gifts which qualified for the 50% or 60% income limitation when given to a public charity will qualify for a 30% income limitation when given to a private foundation. The simplest example is, of course, a gift of cash. Such gifts of cash include both cash given directly to a charity and cash spent performing services on behalf of a charity. There is no deduction for time and effort spent on behalf of a charity. Gifts of ordinary income property also qualify for the private foundation's highest income limitation of 30%. Ordinary income property includes any creations by the donor. Ordinary income property also includes any inventory given to the private foundation. Such gifts also qualify for the highest income limitation available for gifts to private foundations of 30%. And finally, also as before, short-term capital gain property, that is, capital gain property held for 1 year or less, is treated as other forms of ordinary income property and also qualifies for the highest income limitation available for gifts to private foundations. When the donor gives a disfavored asset, long-term capital gain property, to a disfavored organization, private foundation, this results in the lowest income limitation for individual donors of 20%. This rule is simpler than that for public charities because there are no exceptions that can increase this percentage, such as the, quote, special election. Thus, the donor will receive the 20% income limitation regardless of whether the long-term capital gain property was valued at fair market value, available only for, quote, qualified stock, or at basis. Similarly, gifts given, quote, for the use of rather than to a public charity via a charitable lead trust or payment of premiums on charity-owned life insurance also have a 20% limit. Just as the, quote, special election exception does not affect the income limitation for long-term capital gain property given to private foundations, so too the, quote, unrelated use exception for long-term capital gain tangible personal property does not affect the income limitations for gifts to private foundations. Similarly, gifts of tangible personal property to a private foundation are valued at the lower of basis or fair market value, regardless of the related use issue. In sum, the income limitations for gifts of long-term capital gain property are much simpler for private foundations. In such cases, the limitation is always 20%. The previous income limitation rules apply to charitable deductions for individual taxpayers. Corporate giving for traditional C corporations follows a single rule limiting deductions to 10% of taxable income. Just as with individual taxpayers, C corporations can also carry forward excess charitable deductions for up to 5 years. S corporations do not have separate income limitation rules because all deductions simply pass through to become the personal deductions of the individual shareholders. The highest income limitation for charitable deductions of 60% of income applies only to gifts of cash to a public charity. This is the most favored asset, cash, going to the favored recipient, a public charity, resulting in the highest limitation, 60% of income. In order to receive the highest non-cash income limitation of 50%, a donor must give a public charity a non-cash asset that is either not long-term capital gain property or is long-term capital gain property that is valued only at its basis and not its fair market value. Such lower valuation can occur through a, quote, special election or a gift of, quote, unrelated use long-term capital gain tangible personal property. In order to receive the middle-level non-cash income limitation of 30%, a donor must either give disfavored property, long-term capital gain valued at fair market value, to a favored charitable entity, for example, a public charity, or give moderately favored non-cash property, not long-term capital gain, to a disfavored charitable entity, for example, a private foundation. Finally, in order to receive the lowest level income limitation of 20%, a donor must give disfavored property, long-term capital gain, to a disfavored charitable entity, for example, a private foundation. This has been Income Limits on Charitable Deductions, Part 3, Gifts to Private Foundations. Join us next time for Income Limits on Charitable Deductions, Part 4, Carryover Deductions.